What's up, y'all? It's Dr. Dave Roney. Hope everybody's doing well. This is day, 24? 24 of 31, man. 31 straight days posting content to YouTube. Uh, my schedule's been a little off because I've been traveling a little bit, but we're still getting into it, man. Shout out to O'Shaughnessy Ventures, you know what I mean? And the legend, Jim O'Shaughnessy. So let's talk, man. Buying your first home. I think it's important to continue going over like the little nuance and nitty gritty of things, right? Buying your first home is interesting, right? Understanding the difference between mortgages, right? So a fixed rate, meaning it is over the time frame that you have to pay back the mortgage, the interest rate never changes, right? For a bank, that can be risky, right? Because they can lose money on that. There's a trade-off for a bank, right? They have to determine your credit profile. If there's a chance you're going to default, you got to remember most people don't stay in their homes, their first home or second home, really longer than 7 years. They say around 5 years. So the bank, as long as you are a better credit risk, you can get a pretty good rate. Like those mortgages are tended based off of the fixed rate or the federal funds rate. And so you got to pay attention to where those are and where the sort of 30-year treasury rates, right? If you get a 30-year, because they have to match the duration of what they're lending out to make sure that they are sort of getting deposits and they're matching their assets, right? So your loan, right, is a risk for the bank whenever they invest in you and they give you a mortgage. So a fixed rate, meaning you're paying the same, the percentage is going to pay. More typically, they're the opposite of that is a variable, right? So if interest rates go up, you can expect your mortgage to go up. However, there's usually a fixed portion of the mortgage for a time, right? And that can vary, right? Every bank has different products, right? You can get a 7-to-1, 5-to-1, or 15-15. I have one of those, right? Where like the first 15 years is fixed and the second 15 is variable. Majority of people will not allow that variable to kick in because they'll refinance, right? Typically, variable and these adjustable rate mortgages, they are lower interest rates. Whenever there's a high interest rate sort of environment, you can get a sort of better interest rate by agreeing to a variable or adjustable rate mortgage. The problem with this is like a lot of people during the financial crisis, when I graduated college and graduated into a great financial crisis, a lot of people had these adjustable rate mortgages, and then just interest rates and mortgages sort of collapse. And then when the rates sort of change, they can no longer afford the payment. So you got to stay on tack. You got to understand the risks associated with having an adjustable rate mortgage. Now, a mortgage these days typically they talk about the PITI, or the principal, interest, taxes. What's the other one? I forgot the other one. But anyway, on insurance, right? So when you pay your mortgage each month, right, and we call it a mortgage, but in reality is what you're paying is there's the principal of the loan that you're paying down. You're paying the insurance or the interest component. You're putting money into an escrow account typically, like because the mortgage company wants to know that you're going to be able to pay your taxes. That's the T, and your homeowner's insurance, right? Like they want to know that you're going to do that, so they put money aside and they take money every month. Now, with that being said, if your homeowner's insurance goes up or your property taxes goes up, guess what happens to your monthly bill? It goes up. So it's hard to prepare for those things, but like if you know you live in a high tax sort of county, state, whatever, like you have to know, right? So you got to give yourself some wiggle room with your mortgage, right? So in one situation where my sort of all-in sort of payment was around $1,800 in my first home, and then eventually it ended up around $2,400 because as the area around me developed, the houses were being appraised at different values, so the property taxes started going up, right? So that's like a risk, and you're not going to be able to prepare for that. You won't be able to really start to understand what you're going to be paying in the end, because that's something that's going to occur in the future. You can't really calculate that. You don't know if your property tax is going up. It can go up. It can stay the same. So you need to understand. You need to. This is why I talk about not being house poor. When you buy, like, give yourself some wiggle room. Give yourself a margin of safety. I have not. When I bought my house, I did not give myself a margin of safety. It was very, very dumb. I somehow crawled my way and made it every single time. But again, you don't want to be in that situation. Please do better than me. Understanding mortgages is important because when you get like a pre-approval, they do what's called a soft pull of your credit. It doesn't. Your credit score does take a short-term hit, meaning it's very like it's like a blip in the radar. It's not a long-term thing. It's not a hard pull. Hard pulls mean they run your full credit report. So then you don't want a bunch of hard pulls over time. So when you're shopping around for mortgages, you can send your information to mortgage brokers, mortgage loan officers at different banks to try and get an idea of who's going to give you the best deal. And you want to shop around. Now, FHA loans or like loan assistance programs, you got to understand, the lower your down payment, like in FHA is around 3%. The lower that down payment is, that loan, that bank might ask you to pay private mortgage insurance. And what that is that's insurance that you're paying on, that if you default, the bank doesn't lose 100% of their money, right? So like you have to understand those things. Like the VA loan, and there's other loan programs that are sort of partially guaranteed by the government. So it's less of a risk, but there's still risk there, right? So you still go through the whole process. Understanding these things are important because you need to be able to shop around. And make sure that you shop around. Get at least 3 quotes, right? That's an important thing. Don't just go for the first bank because you've been with them. Go shop around, find out what your rates are. And if then once you start to do it, go with the person who like you have a good rapport with, because it's going to be hot and intimate for a couple months while you're trying to get a mortgage. Now, after the first time you've gotten a mortgage, I feel like it becomes easier, right? Not necessarily as less anxiety provoking, but it does become easier. You get that sort of the fact that they know you've already successfully gotten one and you paid your payments on time, like that sort of gives them a little bit more confidence in giving you a mortgage again. But just know, like, for a personal residence, a personal residence is like a single family home or a multi-family that's less than 4 units. Those qualify under a personal residence loan, right? Now, anything over 5 units or over 4 units, you got to get a commercial loan. So if you're like, I'm gonna go buy this apartment building that's 5 units, well, guess what? That's a commercial loan. Those mortgages are packaged differently, and they are evaluated differently than a primary home loan, right? But make sure the key is understanding what you're paying, understanding that your money, some of your money is going to go into what's in an escrow account. Every year they're going to do an escrow analysis to see if you're on track to be able to cover it. You always want to have enough money to cover it, right? If you get extra money throughout the year, you can put money in there. And then if you have excess, that sometimes the bank will send you the excess. Whatever you do, just put it right back in, right? I made that mistake previously and I used that money. It's very, very bad. That's how your payment goes up. Put the money right back in so that you have an excess and just let it sit there. But anyway, I hope everybody's doing well. We'll be back to our normal regular scheduled programming in 2 days from now. I hope everybody's doing well. Please continue to follow me at Fisurgi, FISURGI, on Twitter. And thanks for rocking with me, man. Peace.